All right, so I decided to do a video today. Markets didn't really drop that much, so some stocks did. And we're going to break down stocks like Tesla and Southwest Airlines and Moderna and other stocks that had bigger moves today. But I also know that I'm not going to be around tomorrow, and there's a pretty decent opportunity that a pretty decent chance, of course not 100%, but a pretty decent probability that stocks have a pretty decent down day tomorrow. So just in case, I wanted to make sure that this video is at least posted going into tomorrow. If the market rallies tomorrow, great. And if it doesn't, and if it does fall, then we have an idea of why and how and where it could fall to based off what I talked about today. And that's what I'm going to be breaking down. Again, we do have our holiday special running for the rest of this week going into January the 2nd. You'll see it on the website at the top of our screen. At marketscholars.com, there's a bar at the top that has the link to the code, the coupon code, and then where you can sign up to get that. Again, it's for $2,500 for the rest of this week. It goes up to $3,500 on January the 2nd. So you're going to want to take advantage of that if you're looking to subscribe, or if you're looking to renew next year. You might want to lock in that rate now. So with that said, let's go ahead and get started. Today is Tuesday, December the 27th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here with the red subscribe button down below. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, come out, check out some of these things over here on the right. You can see a lot of people have been taking advantage of our holiday special code here, as a lot of our recent posts, our most popular posts, are some of our premium resources. Getting started with those again. You know, this coupon code goes on for the rest of this week, starting January 2nd after the New Year's Day holiday. Starting on January 2nd, this actually goes up $1,000 to $34.99. Will be our normal price. So that's why a lot of people have been taking advantage of it. Come down here, click on this heart. It opens up that tab. Hit that like button. Same thing, the thumbs up icon. Hit that tab. Hit that like button. Again, the more you like and share and retweet our stuff, the more it helps us get our content out to get it out to everybody, but especially people who are actually following us because of all the engagements that it does have. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the little bit of a decline we had today. Not that big of a move, obviously easily inside the range of what we saw last week. So not a real breakout move. The near-term line still in bullish territory after dropping out of it on last Friday, before Christmas. So jumping back up into it, but your momentum line's didn't jump up. So you don't expect that the near-term line will make very far. You expect that actually the near-term line will follow the momentum line down into bearish territory. So that, whether it's tomorrow or the day after tomorrow, Thursday, more than likely you're going to probably see some more weakness and the near-term line follow suit. Depending upon how bearish we are, of course, will be how much further down does that momentum line go, or does it jump back up tomorrow? That's the big story. Obviously, we are down more than 2.5% below the 30-day moving average. We have dark pink shading and a red line here. So the dark pink shading means the intermediate line's dropping below the 50th percentile. The red line means we're below a falling moving average. So dark pink shading and a red line on the S&P 500. Obviously, on the NASDAQ, it's been very safe. In fact, we almost got a cluster today with the intermediate line in the lower reversal zone, the momentum line to extreme lows. So pretty good chance that we'll continue to be bearish here on the NASDAQ. We're 6% below the 30-day moving average. Of course, your Dow's been the most bullish, and it was actually bullish today, up a little bit. But you notice, again, it's still got a red line. You notice also that its intermediate line actually turned up. Again, momentum line dropped, near-term line rallied, so I wouldn't read a lot into that. And again, it continues to have a very poor margin of safety relative to like the NASDAQ, considering how bearish the NASDAQ has been. Your Russell 2000, which you can kind of see is acting very similar to the S&P, down 4% below 30-day moving average. It's been dark pink shading the red line for quite a bit longer. When you look at the weekly chart, here for the S&P. You can see we got the bearish candle last week. As of right now, it's a lower close this week, and we just barely started. So we'll see whether we get another bearish candle this week with that lower close and that PPO falling. Obviously, the Dow, when you look at the Dow Jones here, the Dow Jones looks, you had the bearish candle finally. You actually have the green arrow though, so you're back, which means you're back above the 10-week moving average. The PPO is rising, and it's actually a higher close in the Dow. So just, you can see the distinction between the NASDAQ, which is easily a lower close and well below, and the Dow Jones. And like I said, if we continue to be bearish here, the NASDAQ is down to its 62% retracement of the post-COVID rally, 38% retracement of the bull market rally off the March 2009 low. That's where the NASDAQ is. The Dow, so that level right here, this is where the NASDAQ is. It's right around 25,500. And you can see how much further the Dow has to fall to catch down if ultimately we end up in a more of a bearish decline. Looking at the 3 green arrow chart, you can see we have 3 red arrows, all across the board. Pink shading, red lines, all the way across the board. Has been the case now for more than a few days, so we're set, right? We are in a bearish move to the downside. Looking at the 2-line versions, you can see the S&P is still down below its 8-day moving average. The 8 and 17 now are about to cross below the 50. The 30 is rolling over. It's rolling down. We're below the point of control, flirting with the bottom end of value area. The NASDAQ, remember, is the most bearish. It is below, well below the point of control. 8 and 17 day are also below the 50. 30 days rolling down. You're flirting with the bottom of the value area even more on the NASDAQ. That the MACD is way negative. On the other hand, for the diamonds, your MACD is actually rising. It's still negative, but it's rising. It hasn't crossed the moving average yet. That's why you don't have the green arrow there. And you are still below. You're kind of right on the 8-day. You're actually still above the 50-day. So remember that the NASDAQ is so far below the 50-day that the 8 and 17 have crossed below the 50-day, and the 30 days falling. Well, see, again, here's the thing about the Dow, is your Dow is so top-heavy. It hasn't dropped as much, and so this is the 2-year chart for the Dow. We are so top-heavy with the volume way up above here on top of us, and there's not very much volume down below us, right? You look at the difference between that and the Qs. See, the Qs are at their 2-year lows, pretty much. The 2 years at their and below the 2-year value area. So you've got 70% of the volume in the last 2 years above us on the Qs, whereas on the diamonds, that's, you are at the bottom end of the value area, but the value area is so high relative to the 2-year range that, we're nowhere near the 2-year lows, and we got those 2-year lows the same time the NASDAQ did. And then again, it kind of goes to show the relative strength of the Dow during this rally, and so far during this decline, but how much further the Dow has to, again, catch down, which is to the NASDAQ, which is way down here. And like I said, closer to its 2-year lows than what you're seeing here on the diamonds. All right, let's take a look at some of these other oscillators. So we'll look at the DMI for the S&P. Again, the negative indicator is above 25. The positive has not dropped below 20 yet. So again, we haven't really started the decline. The Qs haven't dropped below 20 yet either. Again, the decline really starts when you drop below 20. So, yes, we are above 25. You have to have that. And you are above 30, which helps you get that ADX to start to rise. But the other side of it is getting the other indicator below 20. And that just hasn't happened yet for this decline. So if you think that, this decline might be over with, we're nowhere near. Like the negative indicator is above 25 on the Dow. The ADX is plummeted. But your positive indicator, again, is not below 20 yet. So keep that in mind in terms of how far along you may feel like we are in this current decline. The S&P, you can see, the S&P 500, we are still in the lower halves, right? So we're in bearish levels, but we haven't really solidified that yet with a break below 40 on the S&P or on the diamonds. Of course, your NASDAQ has dropped below 40, and you're well below minus 100. So we are solidly in bearish levels. You can see that in the trend strength indicators as well. You're flirting with the value area. The green line has crossed below the blue. You have a weak bearish trend going on the S&P. Your Qs are well below the cloud, and we have also, a weak trend developing. Your diamonds, on the other hand, there's no trend, and we are still easily above the cloud. You do have a negative rate of change on the Dow for the last week, and again, that's a sign that the trend is changing. You also have that, you can see here as well on the spiders. Coming down to some of these other oscillators, like the hull, you can see we're still bearish here on the hull for the S&P, even more bearish on the Qs. The diamonds still really haven't been. In fact, the diamonds are trying to turn up here. We'll see how much it has to turn up. Your McClellan oscillator has been an important thing we've been watching for. We're still negative on the oscillator, which means that summation index is below 0 and dropping. That's an important level. Your money flow is also in bearish levels, so we're still, even though it's rising here, we're still in bearish levels here. So we're still, all these indicators are still suggesting, weakness for the S&P. You can see the bandwidth has gotten up to kind of more in the middle of the range. It's still not even really, when you look at the range of the bandwidth of the last 150 days, you're really not in the midpoint yet, right? There's the midpoint of that. So, we're actually still kind of increasing. Like, it's been up, but it's not up, strong. It hasn't really, like these other legs that have gotten to those, it got to a new 150-day point there. They got to a new 150 point twice on that leg lower, and then it got to, it did not get to a new 150 basis, another new 150 day high. It actually got up, but it did get up in the upper half of the range there. You'd expect that we'd have to at least get in the upper half of the range here, as well as on the this intraday chart. You can see the Arun is still 8%. So the 4-week range still hasn't really jumped, which means we really haven't pushed down to the downside. And you can see the Arun still not very bearish. For the diamonds, it kind of looks exactly the same. For the Qs, you can also see it's kind of the same, though we still don't have that the higher end range yet, which is more around the 15 to 20% range, 15 to 17 for the Qs. Looking at volatility, which had an interesting pattern. I spent quite a bit of time on Friday's video before the Christmas on volatility. So if you didn't watch that, check that out. Volatility did jump today. Volatility did jump today. It didn't jump very much, but it's still holding 20, and we haven't really broken up above. Again, if we're going to be bearish, then the VIX is going to get above this 90-95% area. So that kind of gives you an idea, just how not bearish we are. And then you can see the correlation with the VVIX. Remember, the VVIX was also really, really low on Friday, and actually stayed at extreme lows here. So again, the volatility, the VIX has compressed all year long. It's really setting up for a breakout move. And again, the expectation is, considering the VVIX is at extreme lows and it's not very much further down, it can go down further, right? It can go down further, but there's not a whole lot of downside to where the VIX is, right? See, in 13 and 14, it spent time below this. But remember, in 13 and 14, we had high liquidity in terms of QE and 0% interest rates that we haven't had since COVID, since this COVID area. And even then, that was with a jump in volatility, and we've really compressed. After 2 big years, 2022 has been a compression in volatility, despite the fact that the S&P is down 20%. And again, you would expect that this wouldn't hold for very much longer. Again, for a refresher on that, watch last Friday's video. I spent quite a bit of time on this divergence type move we're getting on volatility that would suggest that 2023 will be a lot more volatile than what we've seen so far in 2022. All right, now let's take a look at the different asset classes and how they're performing. It's interesting today. It's not surprising. Bonds dropped quite a bit, 2%. That's a big move for bonds today. And of course, that put a lot of the long duration asset classes down, like the Qs down 1.5%, high yield bonds down 1%. They all got impacted the most. Commodities and gold took off, even though the dollar was down only just marginally. Commodities and gold took off, and of course the reopening trade, which really has pumped up a lot of this move in China, pushed EEM up 1.5%. So big move higher in some of these international areas. Now remember, some of these international areas like emerging markets they've been in a bear market. So we've been anticipating spiders starting a bear market here in 2023. EEM has been in one. It's been below its 200-day moving average all year long. Is now kind of coming up towards it. It's making a new leg higher now off of a higher low to the upside on the daily chart. This is what the weekly chart looks like, and you can see again, MACD is high, or has been high. The stochastics has been high. So emerging markets are making a pretty decent run. But really bonds, like that was a pretty significant, after a big breakdown last week, you can see we're discontinued that move, and the MACD is rolling down. Stochastics is rolling down from what would be a bearish peak. This is what it looks like on the daily chart. I mean, breaking back down below the 50-day moving average, the 8 and 17. 8's already crossed below the 17. The 8 and 17 are crossing below the 30. Big move, and it's really the 10-year yield is jumping up. Like it's back above its 50-day moving average. It's back up to 3.5% or 3.86% now. That's a big move. In the last 2 days, we've gone from 3.66 to 3.86, 20 basis points. I think the bond market's finally kind of realizing that the Fed's going to raise rates. That, there was the Tom Lees of the world who thought, well, maybe they won't raise rates this year. But, that you can see the odds are, that they were done in December, right? They won't raise rates at all this year. But the odds are they will. And you can see, and there are still 100% odds that they're going to raise it at least 25 basis points, and now increasing odds that they're going to raise it to 50, right? And it's not increasing by a lot. It's still low probability. But, the odds of being at 50 were above 60 at one time. So it wouldn't be a surprise if they say we're going to raise it up to 50 basis points, up to 5 full percent. And remember, the 10-year yield is actually still it's at 3.86, not 4, but 3.86. So it's way behind the curve. And you can see as a result, it's catching up. The yield spreads are catching up here. They're still at 65 basis points, so they're not necessarily back to zero, but they're off their lows. This spread's only at 50 basis points. This one's way off of its lows. So they're starting to move. The 3-month has been moving up higher too, because remember the 3-month has got to kind of get in the mode of catching up to getting to 4.5%. You can see it made a big jump here from 4.33 to 4.5%. The 2-year didn't quite make that big jump. You can see it's still here at 4.34, and that's why this spread still at right around 65 basis points, because that 3-month ran up so much. But this one, the 2-year's not. So it's kind of interesting. The 2-year's got to, that's a big spread right there. 16 basis points between the 3-month and the 2-year, and negative 16 basis points. That's a big inverted yield curve on a spread that's typically rarely negative. Had the 3-month over the 2-year, especially by that amount. And again, it's this idea of the Fed's actually going to raise rates, and if they don't raise it to 5% in February, there's an 88% odds, which is way higher than it was just a week ago. Was 75%, and now a month ago was at 90, and it's getting back to 90 again. So if they don't raise it to 5% in February, the futures markets, why are they expecting them to raise it there by March? And that's really not the MO to kind of slow it down to 25. The MO was to probably do one more 50 and then overshoot and be done, right? And I don't necessarily think 5% is overshooting, but considering where the CPI is, because again, this would be the second time in years that they have stopped raising rates before the real Fed funds rate gets to negative level, positive levels. The first time was back here in the 70s. So back over here in 2018, they raised rates in December, and they got it to right there. They got it to positive. They had just barely got it there to positive levels. So that was the end of that rate hike cycle. It started in December of 15 and went pretty much through December, slowly, but pretty much through December of 18. And they stopped raising rates after they got it positive. In fact, they got all the way up to a full 100 basis points positive. So this would be the second time that they stopped raising rates on a rate hike cycle. If they stop raising rates in March at 5% or even in February at 5%, this would be the second time they've stopped raising rates, assuming that, before the real Fed fund rate hits zero. And again, the last time is the time that keeps getting mentioned by the Fed as what they do not want to repeat. So I know there's a lot of people focusing so much on the Fed, on the CPI coming down. The CPI is going to come down. So it's pretty basic to be considering, hey, the CPI is coming down, now everything is done, right? I know that's a very common thing, and I know it's like Tom Lee's big thesis for 2023. But the reality is, of course it's going to come down. And when it goes up, it always comes down. So the fact that it's coming down is not a big hot take in the least bit. What we should be more concerned with, and what the Fed is concerned with, and what no one's really listening is, they're concerned about another spike, another hike. Right? And that's their concern. It's great that it's falling. It fell back here in the 70s too. Right? It's great that it's falling. That's not their concern. Of course they wanted to get back down to 2%, but they want it to stay at 2%. And that's the key distinction. And that's why they're going to raise rates longer than what a lot of people think, because they want it to stay at 2%. They don't want it to turn back around and go back up to 5, 7, 8% again, because unemployment's still incredibly low, right? And historically low. So keep that in mind in terms of, the CPI is going to be down to 2. It's dropping so fast. Yes, that's great. It always drops as fast as it rises. So that's not a news flash in the least bit. What is the news flash is that, apparently for the markets, is the Fed actually is going to keep raising rates because they don't want this scenario of a second spike, which is actually worse than the first, to happen again. You kind of got that back here too with the housing market. They stopped raising rates there in June of 2006. That's when they stopped raising rates. And then you can see inflation came down, right? But then it turned back up and spiked here in 2008 up to over 5%. After 2 years after they stopped raising rates. They don't want a second hike, a move higher, just like we saw over here. They don't want a second move higher to occur again because they stopped raising rates too early. Because again, we saw back in the 70s, like the peaks tend to be higher, and a higher peak than 7.5%, we're looking at double digits again, and nobody wants that. All right, now let's take a look at what's driving a lot of this price action today. And again, down 0.4%, and you can see the biggest losers were the three big sectors. And there was some chatter today about, like, can the market go up without those three sectors? And I tweeted this out. If you follow me on Twitter, I tweeted this out. Those three sectors, this kind of tech-centered cyclical sector, kind of long duration, has been talked about quite a bit. High growth areas. They still, even though they're down off their peaks, they still make up over 40% of the S&P. Most of that's from XLK, right? But they still make up over 40% of the broader market. So this other cyclical basket, which is kind of more correlated with the Dow and more correlated with, people associated with a value and have correlated it with the Russell as well. There's some correlation there. These kind of smaller sector weightings, they make up 30%. So those four sectors that make up only less than a third of the broader market. So, we still don't know necessarily if the broader market can sustain a big long-term trend. Of course, you can make an intermediate rally. But our last intermediate rally was lifted by those. So it can fuel an intermediate rally. Can it fuel a market sentiment rally? That's the question. And until these disparities resolve themselves, then I don't think we can get going to the upside without the three big sectors. And of course, today they were the biggest losers, and that's what brought the S&P down. Your biggest winners were in that other cyclical area: energy, materials, industrials, and financials, along with utility staples and real estate and healthcare. I mean, those were all your defensive areas and that kind of quote unquote value area. Those were your biggest winners today. If you take a look at some of kind of what some of the biggest winners and losers, Tesla was, of course, the biggest name that got dropped here today. You can see this is one of the biggest stocks in the consumer discretionary space, and boy, is it gone parabolic. In fact, its ADX is almost a 40. It has been pretty much since October when it started this decline. You've had a couple areas of light green shading, but it's pretty much been bearish. This is the highest that the negative directional index has been all year, and it's been really the highest that it's been in the last 5 years. The other time that it was this high was back over here, and let me change the chart so that it there we go, so we can see what it looked like. So this was the last time you can see that your negative index, if you follow my cursor all the way over to the right, was as high as it is now. And you can see the ADX eventually got up to almost 50. The ADX is lagging. It peaks after whichever one is the biggest peak. And you can see it peaks after the blue line on the bullish moves, and it peaked, but it's not very far after. So it peaks after that. So, we have to peak here first. But you can see, like we had over here in May of 2000 going into June of 2019, that's when the 10-year note dropped below, 2.25%, I believe. There's another tweet I put out there. Once that 10-year note dropped below 2.25%, Tesla took off. Up here, the 10-year note dropped jumped back above 1.75%. And that's put a lot of pressure on Tesla, especially considering it went from $11 up to $400. Again, split 5-to-1 back here in August of 2020, and then another 3-to-1 here in August of 2022. So keep that in mind about the pricing. But this is, again, we haven't had this level of negative DMI, directional index, along with such a big drop on the positive index, again, since May. And you can see that sparked a pretty decent run there. When that will spark, when this will get down, I wouldn't put any stock into Tesla turning this ship around until, we start filling in some of these gaps. Now, this could be an exhaustion gap when you got a big move, up or down, considering, again, how high that negative and how low the positive directional index is. It increases the odds. So I would say you have to fill back in that gap there, at least before you start thinking about a bottom developing. And that 8-day moving average definitely has to be breached. This is easily the lowest MACD that we've seen, again, in years, right? You have to go back, again, all the way back to that 2000, to the COVID drop to have a deeper MACD. If you follow my cursor along, this is a normalized MACD too, so we can compare it to all these other levels with smaller prices. Even 2019 wasn't nearly as bearish. There wasn't nearly as much bearish momentum as what we've seen now. We've pretty much broken the 62% retracement of this big long rally we've had, and then now. So I would say there's going to be some support around this $100 level. Obviously, it's a big number. So there's going to be some support from there, a little bit, plus or minus a few bucks, because you got that 78% retracement level right below it. So that was a big mover today. You can see some others. NVIDIA was also a big loser. Way down over here, you can see Southwest Airlines. Southwest Airlines is just having a day. It's had a bad Christmas holidays. And you look at that breakdown there. So, like the rest of the broader market, we had broken the 50. The 8 and 17 were close to crossing below the 50. And the 30 days rolling over. Well, Love has really broken down. And it's broken down out of the bottom of the value area. If I were to zoom out here over the last 2 years, you can see there's not a whole lot of upside. We are really breaking down here. Love is in with a lot of volume. Now, again, a lot of volume like that, and you saw that as well on Tesla. When you get a big chunk of volume like this, with that gap, it can have some, some exhaustion type gap qualities. So keep that in mind. Love's a little different than Tesla though, because we've been bullish and has been rolling over, and it actually looks very similar to the broader market, and it appears it's preceding the broader market's decline, and what way may be coming. We saw Nvidia as well. I mean, look at that breakdown below the 50-day moving average on Nvidia. The 8 and 17 are crossing below the 30. These are pretty significant moves on some of the bigger name stocks in some of these sectors. In the healthcare space, look at Moderna's decline. Moderna really dropping pretty sharply here. Moderna, again, breaking the 17 and 30-day moving averages all at the same time. That's a pretty big drop. Again, we had a divergence on the MACD, had a divergence on the stochastics. You have a divergence on the RSI and the CCI as well, lower highs, big time lower highs in the CCI, really breaking down pretty hard. So if we were to take a look at the options chain here for Moderna, you can see going into January expiration, some pretty significant, some pretty decent opportunities here. If I were to go back, let me just go back to the bandwidth for the stock. As you can see, remember, it broke below multiple moving averages. It had been above the Keltner channel, and you can see it's got the bands have moved back inside of the Keltner channels. As wide as that bandwidth is, it's still not in the upper half of the bandwidth, but as wide as it is, we had the big move, which did get the bandwidth up into the upper half of the 150-day range. You did get a lower move, and it looks like we were breaking out, but it looks like now that breakout is more like a fake out. And we've pretty much now erased that breakout with today's move. And now we're down towards the lower quartile, and it looks like we may be switching from a positive momentum to a negative momentum here on Moderna. And you can see going out to January expiration, $150 is in the 1 standard deviation range. When you look at this stock, $150 is right back down towards a 200-day moving average, starting to get down towards that level. So if you say, okay, well, let's not quite go to 150, let's go to 160 and 165. Again, it's going to be relatively wider spreads. So let's see if we can price it for $145. And let's put multiple contracts here. You can see I'm getting about a 3-to-1 reward to risk ratio, and the maximum gain is relatively easily inside of. So it's a relatively higher probability directional trade to the downside, and set up for a pretty decent return. Of course, if we bounce right back up, take a few $100 loss, and make that reward to risk ratio even better. But the setup is looking pretty decent for a bearish trade down to the downside. So let's stick that into the market outlook category here for tomorrow. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. And like us on Twitter and Facebook as well. Have a great rest of your Monday night or Tuesday night, everybody, and we'll see you all next time.